Imagine a new Bretton Woods etched not in marble, but in a line of code, where a digit dollar clears in less than a heartbeat. It's no flashy Valley token, no Beijing Yuan. It's a federally approved rail that locks US money onto an open ledger, and hardly anyone asks why. Before we dive in, take a breath and pour that coffee. Today's story isn't crypto hype, it's the hidden plumbing. How Washington quietly repipes global trade while markets fixate on ticker blur. We'll track Hill's draft bills, unpack tech that outruns Swift lag, and spell out what it means for your cash, your trades, and America's reach abroad. Since '44, the dollar has leaned on two anchors: faith in Treasury IOUs and the wires that clear them. Fedwire, ACH, slow, gated, costly. Dollar-backed tokens change that, moving value as effortlessly as email. On-chain transfers already outrun Western Union, edging toward ACH flow. Hill's Genius Act and Haggerty's twin techs would license banks and bank-like fintechs to mint green tag tokens backed by T-bills. High reserves, real audits, zero algorithm tricks. Hill calls it a rail, not a toy. Every empire tweaks its clearance layer when margins tighten. London turned to gold bills. Tokyo favored euro-dollar swaps. Now DC eyes token rails to defend market share as BRICS craft rival networks. This is defense in fintech clothing. A vetted token could hold allies in the dollar zone just as energy deals drift toward Yuan and ruble rails. Think Bretton Woods code. Hegemony via instant finality. Why now? Look to 25 ballots. A new White House needs income without fresh tax and craves a tech win that humbles Fed CBDC talk. A charter token fits. Private build, federal guardrails, foreign policy flex, no filibuster. But pundits miss the kicker. Fast token shift who earns the float. Today, big banks bank the lag. In a token world, yield drifts to wallets and DeFi pools, nudging bank funding costs higher even if Jerome holds rates flat. Early winners, Circle, PayPal, and Visa pilots. Gateways like Swift risk fee fade unless they merge or build bridges. Underwriters eye a wave of rail-ready firms. Billions could list with fees rivaling the Fannie Freddie float we covered last week. Hedge funds and commodity desks cheer. On-chain dollars cut daylight drag and collateral haircuts. For them, this isn't decentral dreaming. It's margin windfall. Knock-ons to watch. Euro-dollar futures may thin as repo tokens offer one-tap leverage. Reserve banks could tuck tokens in vaults, bypassing correspondent banks. Oil trades might clear T+0 in ledger dollars, undercutting Yuan quotes. Money market funds feel it first. 4% token yield plus anytime exit may lure cash away, forcing managers to sweeten terms or shrink. Quiet angle, a token dollar is still an IOU. Allies see safety. Rivals see a trap. Expect gold-backed clones aimed at dodging that gaze. If a bug or ban hits, reserve desks could pivot to Eurobonds or bullion overnight. Tail risk matters when value moves at light speed. Thus the dilemma. Will a turbo dollar fortify US reach or hasten fragmentation as others copy the rail? Every upgrade invites a leapfrog. A fast rail won't mend wages or fix freight lanes. It financializes cash, moving control from siloed banks to code. Retail loves friction-free flow, yet they shoulder smart contract risk and round-the-clock swings. T-bills in your wallet at 2 a.m. feel grand until an Oracle glitch blocks exit. History rhymes. Venice had ducats, Britain issued banknotes, America weaponized Swift. A vetted token feels modern, yet beneath the gloss lurks an old game. Consolidation and data grip. Window for movers, track committee edits, wallet risk briefs, and chain analytics flagged as critical. Position in compliant custodians. Watch MMF outflows. Gauge token liquidity. Latency arbitrage may be the next carry trade. Share this with anyone who calls stablecoins a fad. Comment below, will this rail anchor US dominance or spark revolt? And for more sharp takes, tap subscribe. History rhymes, power rebrands, stay inquisitive.